Here, we start the discussion about required rate of return. Okay, required return or required rate of return, it doesn't matter, right? But it means the same thing. Also, it has another name of it, which is opportunity cost of capital. Opportunity cost, what do you mean? What do you mean, right? Well, if you think about the investors, put yourself in the shoes of CFO. Okay, you're the CFO and you want to raise equity capital in the stock market. Okay, and then convince to the investors and say, you put your money, please. This is a very attractive company, my company, right? Then you'll have a certain amount of returns later on. Okay. A certain percentage, cannot guarantee, of course, but you will have great return later on. You discount it somehow, blah, blah, blah. And you apply some discount rates, which is your returns, right? Investment returns. What will the investor say to you? They will always say, wait a minute, why do I have to bother investing in your company? With the same equivalent level of risk, I can expect a lot better return by investing in your competitors over there. Right? So for investors, right, by investing in your company, they are foregoing other investment opportunities. So what they require as a return, okay, expected return or required return, right, is by nature is an opportunity cost for the investors. This is an opportunity cost of capital. This is what they require as a return. So that's what why we call two different ways, opportunity cost of capital or required rate of return in the market today, right? Now, this required return largely has two components in it. Okay, that is risk-free rate and risk premium. The idea is this. Well, your company, again, put yourself in the shoes of the CFOs. Your company is always risky. Okay, the investors, let's take the perspective of those guys then. Well, with a certain amount of money, they could always invest in the safest asset, risk-free asset. That should be first benchmark, right? And then say what to you? Oh, you want me to put $1 million to your company? I could have put my money into the risk-free asset, U.S. Treasury, $1 million over there. They give me 1% return per year. So as long as you are risky, you should give me better return than 1%. That's the idea. More return expected than safest asset. Okay? That's risk premium. So that's why we have two components, risk-free rate and risk premium. Why risk premium? Because those investors are risk averse. I'm going to ask you this question in the final exam, guarantee you. Risk premium is a function of risk aversion. Okay? The more risk averse, the higher return we want to get. Okay? Safer assets, smaller risk premium. The safest asset, risk-free rate, okay. Right? It's a direct function of those risk aversion. It happens. Right? Risk premium. Now, those asset pricing model is essentially about how to disentangle those, interpret those risk premium in a more structured way. The second row shows capital asset pricing model idea. Okay, there's one risk factor that is market risk. Okay, market risk. Whole macro economy gets hit, the whole market gets affected, and your stock will be affected proportionately somehow. Okay? So that's the concept of beta how much sensitive is your stock relative to the market movement, okay? And then multiply your beta times by market risk premium, something called market risk premium. That's our grandpa model developed in 1960s and got Nobel Prize by, Harry Markowitz and then William Sharpe, Lintner, right? All those guys. Now, later, people found out that this is capital asset pricing model turns out to be one special model. There could be more general model. Market risk or macro shock is not the only source of risk, okay? As it turns out, there are multiple factors coming in, multiple risk sources coming in, okay? Size of the companies, right? Which has nothing to do with your market risk premium, okay? Still affect your return. And then book to market kind of things, significantly, related to your growth opportunities. I told you before, growth options in your asset, like patents. Some companies have more of that, some companies have less of that. That makes difference in terms of risk premium, which is not explained by market risk premium as in capital asset pricing model. So they come up with Pharma French 3-factor models, 4-factor, 5 factors, like N-factor models. And then arbitrage pricing model also explains those things in different angle. And then using this arbitrage concept, we're going to talk about it later. But primarily, in this semester, we're going to play with capital asset pricing model, the basic grandpa model that everybody has to understand. Even the marketing people or HR people have to understand it, okay? So, let's move on. Risk-free rate is our first component, right? Which is this guy over here. No risk, no fun. All right, before we move on to discuss risk-free rate, okay, let us discuss something about closely related concept, especially the ones related to Federal Reserve, right? Federal Reserve. Now, the typical risk-free rate will be something called the U.S. Treasury rate. Let me state it clearly upfront right now. But every now and then, what matters for this risk-free rate in the typical financial media setting is really Fed funds rate or the Federal Reserve's announcement about the target rate of Fed funds, okay? Fed funds rate is not equal to the risk-free rate that we are going to use in our corporate finance setting, the U.S. Treasury rate, i.e., okay? Those two are different, right? And I want to make a clear line between these two. And for that purpose, let's go through this news article over here. Just happened over the weekend. On Sunday, Federal Reserve Chairman, right, Jerome Powell, Mr. Powell, he said after FOMC, Federal Open Market Committee, right, they determined to reduce the Fed funds target rate to 0%. Target rate to 0%. And they will do a massive $700 billion of quantitative easing program. We're going to get back to this QE later on, okay? How is it different from that typical monetary policy that we usually talk about, right? So wait for that one. So why did he announce this kind of lowering down of Fed funds rate? Because they wanted to lower down the risk-free rate in general in the market, so much so that the borrowing rate will go down so that the business will take off, and then they will, easily borrow and then do more business, and then easily borrow and spend some more. So both supply side and then the demand side is stimulus. They try to stimulate somewhat more, right? But how much effective is that? Okay, given that this is coronavirus economic crisis, this is not just financial crisis. It's about both supply side and economic, the demand side shock. Not just a shock, it's a total devastation. For example, how many of you want to go to different countries flying airplanes with potential of getting infected more? Okay, nobody. How many of you are willing to work offline? Okay, going to factories and meet some your boss and then risk the chance of getting infected? Nobody, right? Production goes down and then consumption goes down like crazy. All right. In this situation, how much is this monetary policy effective? We call it monetary policy. What the chairman of the Fed is trying to do. Okay, essentially pumping the money into the system. Right? How much effective is it? Money is like a blood, but do we need more blood or something else other than that? Do we need some more meat? Right, instead of blood, muscle, okay, transplanting the muscle somehow, right? So that is a valid question. How did the market respond? Well, if you look at the next slide, all red, which means on Monday after the announcement of Powell, the stock market tanked by 12%. Dow Jones Industrial Average, S&P 500. Yeah, similar, right? NASDAQ even more, of course. Anyway, all around the world, DAX, FTSE, CAC, that's French one. DAX is German, FTSE is London. All around the world, including KOSPI over here, Korean stock market. All the stock market investors were, disappointed or even more spooked, okay? So you cannot stop the crisis right now with this monetary policy yet. Of course, you could predict this by looking at this news article over here. This guy, Grumble, the futures trader, on Sunday, you could see the futures market movement. Even if it is not a trading day for stock market, futures market, there is number, right? There is something going on there. Now, let's move down. Here, what you see is the historical Fed funds rate, okay, movement. How much, what was that like, right, over the last 15 years? 2008 financial crisis, and then more than 5 years, it has been 0% rate, okay? Now it's getting back, right, to 0%, right? Now, for this part, we need some distinction. I told you before about the Fed funds rate. What is that about? Okay, what is that about? This is the rate that the central bankers intend to control, but they cannot specifically say to the market that this is the Fed funds rate. But this is a target rate we intend to, so that they will converge in the future. Okay, so what is that? But for this purpose, we need some discussion about the basic of depository institutions. A refreshment of your macroeconomics 101, I guess, right? So let's see. Here is a central bank. Can you see in this picture my bald eagle? Yeah, bald eagle. Why bald eagle? This is a statue that you see in the Federal Reserve of the United States, which is the central bank of the United States. Notice Bank of America is not a central bank of America, even though Bank of Korea is a central bank of Korea. Confusing, right? Some people remember me as a central banker guy. No, I've never worked for central bank. Anyway, FRB, Federal Reserve Bank, is the name of it. We're going to get back to its history later on. Wait for that. Now, Federal Reserve Bank, right, is there. And then there are many depository institutions, which is banks, like Bank of America, and let's say Citibank, okay, is another depository institution. And nowadays, Goldman Sachs, which is another depository institution. Okay? Right. Many of them are there. And if you look at the balance sheet of any one of these depository institutions, it looks like this. Key part is this balance sheet deposit. Let's say here comes one person, Andy Kim, and then with the $1 million in cash, $1 million, right? And put it as a deposit. That goes into the deposit, $1 million, okay, $1 million. Cash, of course, 1 million. But Andy is not the only one. Actually, there are, let's say, 100 of them, okay, coming in, 100 of them coming to Bank of America, right? So each $1 million. So in the end, they're gonna have, the bank is gonna have a deposit of $1 million and cash $1 million. Make sense? You may wonder, deposit, that's my asset as an individual. Andy's balance sheet will say deposit is my asset. But from the banker's perspective, that's the banker's liability. Why is it liability? Because whenever Andy comes there and say, give me my precious deposit, and then you have to pay me my deposit plus interest, by the way. Yes. So that's the banker's liability. That's the hard part, confusing part of bank balance sheets, okay? Flipping the sides, right? Now deposit 1 million, that's liabilities. And the bank got $100 million. Happy? Really happy? Not really. You have to make money based on this cash, okay? And then you have to find out some good place to invest. In this case, lend money. Let's say you found some corporations, say, let's say Volkswagen, okay? Volkswagen, and then you lend this money and say, build some good cars and then pay me interest so that I could pay back to my depositors later on. Good. Not only Volkswagen, you can go to Hyundai Motors and all these kinds of companies, and Samsung, you lend money so that you get some interest return, right? And pay back to the depositors. But one thing to notice is that you have to keep a certain portion, certain part of this deposit as a reserve. You cannot lend 100% of your deposit to other companies. Why? Because at random time, your clients will come and say, give me my precious deposit, right? How many of them, at what time, we don't know. But we may have some good idea about it. So let's say 10% we keep it as a reserve, right? Reserve. 10%, 10 million, okay? And then this cash balance, let's say 10, the exact number is not important, but the proportion, let's say 100 million, you get cash, then out of it, keep it 10% of it, keep it as a reserve. Okay, keep 10% of your deposit as a reserve. Where do you keep this? Not in your vault, but in your central bank. This is why the central bank of the US is called the Federal Reserve Bank. Reserving what? Reserving part of the depository institution's deposit amount in this vault. So that in the emergent case that so many depositors come and give me my money, and this guy will help somehow. The key idea was there. Basic intuition is there. Okay? So reserve is important. Every bank has the reserve. Let's say BOA reserve. And Citibank has their own reserve as well. And I'm going to draw this with red because the Citibank, can you see it? Citibank umbrella, right? And then this guy would have their own reserve. Citi. And then Goldman Sachs, okay, Goldman Sachs, I would say reserve, Goldman Sachs, right? The law would specify X percent, 10% to reserve, but depending on the time, right, the actual reserve amount would fluctuate. So much so that some depository institutions may have excess reserve. Let's say Bank of America, because that's the one that I used to work. They have excess reserve. They have excess reserve. Okay. And sometimes the Citibank on that day, they have need some reserve. Okay. For some reason, they don't have enough cash, and then they had a lot of deposit coming in somehow. This balance mismatched somehow, but they needed to fill in some kind of a reserve into the vault in the central bank. Excess and then a deficient reserve. What do? Well, these bankers over there call up each other and say, well, Mr. Bank of America, I want to lend. Could you lend me some money based on your excess reserve? So because I need some reserve myself, okay, overnight, just one day or two, okay? And the Bank of America guys say what? Okay, no problem. Okay, I'll lend you, but you need to pay me interest. That interest rate is called Fed funds rate. Okay, this is borrowing and lending. Let me draw it with another color. Excess reserve, needed reserve, lending rate at Fed funds. Can you see it? Fed funds rate. Fed funds rate, right? These two banks borrowing and lending based on this reserve in this central bank, okay? Short-term borrowing rate. That's Fed funds rate. Supposedly the high-quality banks in the first place, very safe banks, and then their rates will be very low. And so Fed funds rate, this is the rate that the central banker over here, okay, Mr. Powell, they can target. They cannot dictate. Okay, they cannot dictate. You, Bank of America, lend it at 0%. No, because this has to be private market somehow. But they can influence and target it so that it will converge to 0%. Okay? So that's what's going on with this Powell's announcement. Fed funds rate. Having said that, there is another confusing concept, okay, called discount rate. Discount rate, or the rate of borrowing at the discount window. Okay, what is that discount rate? That one, okay, is, you can imagine this kind of situation. Here is a poor bank. Okay, bank. Let's say bank. Troubled bank. Okay, their depositors comes in. Okay, but they don't have enough cash. But they don't want to go bankrupt. So then what do? Come to the central bank and say, we need immediate cash. Okay, we need immediate cash overnight, right? There you see a discount window, okay? And say, hello, I will lend you some money, okay? And then overnight, short-term period, okay? To save you, bank. That's discount rate, okay? That's discount rate and risky rate, because that has to reflect the riskiness of this borrowing bank, the discount rate. different from Fed funds rate. Jerome Powell targets at this one. Discount rate, no, it's just determined separately. Okay, what is important in the news is this guy, and then this guy, Fed funds rate, is closely related to the U.S. Treasury rate. We are going to talk about from now on. Okay, from now on, U.S. Treasury rate is a separate issue from this one, but it is influenced by this, goes together. Why? Because their riskiness, US government, Treasury, and central bank, their credit worthiness is the same. So Treasury, here comes Treasury. US Treasury, let me draw a picture over here, right beside the eagle, right? Okay. Here comes US Treasury. Treasury US. Okay? You are talking based on US setting. Anyway, any country's treasury could be it. Okay? Treasury, okay, any country's treasury, Ministry of Finance, right, is this one over here. What do they do? Based on the collected money, tax money, right, of the taxpayers, they do something for the country. Okay, makes sense? Building bridges, building highways, high-speed bullet train kind of things, right? SOC, social infrastructure kind of things. Or this kind of coronavirus situation, immediate help for the affected people and the companies. They can do it, but they don't do it right now. That's why the stock market is crashing even further. Okay? Why? Because some of these conservative people in the politics say, no, the treasury has to be small. Their functioning has to be very, very small. Don't intervene in the market. Let them suffer. Let the natural selection happen. That's conservative approach. But right now we need some stimulus, fiscal stimulus like that. I hope those conservative people understand this situation. By the way, so U.S. Treasury or any treasury's function is like that. Public policy, monetary, public policy is something they are. Fiscal policy is something they are up to. Okay, monetary policy is up to the central bank. Fiscal policy is the responsibility of the Treasury, okay, Ministry of Finance. Okay, so they collect money of tax and then they deposit in the central bank like that. These guys will also have some balance sheet. Every entities in the world, we can interpret in accounting balance sheets like this, and we create another one. The U.S. Treasury balance sheet, let's say over here, balance sheet. Okay. Cash will be there, right? Or deposit in central bank will be there, of course. But at the same time, I said public projects. Can you see it in your, yeah, projects like public policy projects, okay? That should be their investment into the bridges, okay? Spend some money on this. They can directly spend the cash themselves, but they can do it in other ways by borrowing money, okay? Which is called issuing treasury security, okay? Issuing bond, okay? Issuing bond, let's say bond. That's IOU, okay? Here we are building bridges. I need to borrow your money, please. And they issue bonds to all different kinds of investors, bonds, IOU to other banks. Let me right? Erase this part because you don't need it, okay? All right, you don't need it. And then bonds, issue, bonds, issue bonds to different investors like Citibank and Goldman Sachs, right? And sell the bonds, and they put their money, okay? They borrow, they lend those money to the U.S. Treasury, okay? That's what's going on U.S. Treasury market, right? They issue bonds to global investors so that these global investors will have some return based on this investment, okay? That's Treasury bond market, right? To support their public projects like this, public projects. And now comes the central bank, okay? Typically, to make this target Fed funds rate go up or down, okay? What do? They do open market operations. Come to this bond market, eagle flies to the bond market and do open market operations. Right? Open market operations. Why is open market? Why is the open market? They go to this open market of Treasury bond, where the Goldman Sachs and Citibank and then Bank of America, all kinds of banks join, and then put their money for the public projects of building bridges like that. Open market. There, the central bank used to, okay, this usually, okay, influence this Treasury market rate in the short-term rate, 3 months T-bill rate, for example, 3 months maturity or 1 month T-bill, kind of short-term maturity bond. These central banks buy and sell, okay, buy and sell, so much so that those 3 months rate goes down, then the Fed funds rate will go down together with it. Because short-term 1 month rate goes down, that implies that even shorter months of shorter time period of Fed funds rate should go down together with it. So their influence on this Fed funds rate is rather indirect, going through this open market operations. Okay, short maturity Treasury bond market, they were buying and selling. We're going to get to that idea later on more precisely. Now, one more concept is the quantitative easing. What do you mean by quantitative easing? The way I understand it is that this it's an extension of this kind of open market operation into longer term government bond. Okay, in conventional open market operations, it was the central bank was just going there silently and then just buying and selling the short maturity debt. But in quantitative easing, they specifically say what billions of dollars we're going to spend. Number two, they are buying and selling longer term bonds as well as short term bonds, right? So 30 years bond or 10-year maturity bond, quantitative easing policy touches upon that. Previously, in open market operations, no, okay? Usually not. So that's the distinction that I make. Now, the next slide, let me see. Okay, now we set the distinction between the Fed funds rate and then the U.S. Treasury rate. Okay, Fed funds rate, among these guys, U.S. Treasury rate is this guy over here. Okay, Fed funds rate was about this reserve. Okay, U.S. Treasury rate is about this guy being the borrower. Okay, U.S. Treasury. Now, U.S. Treasury yield curve is shown over here. What is a yield curve, by the way? Okay, what is a yield curve? Well, what you see on the vertical axis is the interest rate in percentage figure, right? And then what you see on the horizontal axis is the maturity of these bonds. Okay, you see a whole spectrum of maturities, different maturities issued by the bonds issued by this Treasury, not the central bank. Don't get confused, right? They're different guys, not the eagle, but this guy. Okay, in Korean terminology, this is equivalent to Bank of Korea, 한국은행, and then this is equivalent to what? 재경행시, right? Like what's that? The Korean Ministry of Finance and Economics, or Economics and Finance, the other way. Anyway, so they are two different entities, right? Treasury is about this guy. Treasury is about this guy. And then they issue bonds with all different maturities, 1 month all the way up to 30 years. And their interest rate or their expected return in the market, bond market, will be different depending on the maturity, as you see on this yield curve. That is what this yield curve is about, right? The interest rate, the plot, it is a plot of interest rates across a whole spectrum of maturity of the treasuries, from 1 month all the way up to 30 years, and then I show you two yield curves, by the way. One is the blue line, which is the yield curve before the announcement of Jerome Powell, and red line is the yield curve after the announcement of Jerome Powell. What do you see? Did it go up or down? Shifted up or shifted down? Shifted downwards, right? Especially which part of the yield curve do you see more drastic movement? I say longer end, in the 10 years and 30 years, right? Why is that the case? Well, majorly because of the $700 billion of quantitative easing plan. I told you before, as opposed to open market operations, quantitative easing is about more to the longer term U.S. Treasury bonds, right? So that's why the quantitative easing is affecting more of the longer maturity part of it. I'm not going to test you on this in the exam, so don't worry about it, but just to get a sense of it, And Fed funds rate, that's 1 day, 2 day rate, very short-term maturity. And on this graph, you also see that impact on the 1 month and 2 months Treasury yield, A 1 month yield is disproportionately more going down compared to 3 months, right? Well, situation may, be different. There's no strict rule about it, but at least 1 month is more closely related to this Fed funds rate or overnight rate kind of things. So they should be reflecting faster, I think. Anyway, so that's basically what we see in the U.S. Treasury market, depending on the announcement. Now, how is it important? Why do we care about this in corporate finance setting? Because this U.S. Treasury rate will be your starting point of risk-free rate, The U.S. Treasury rate, as long as you are valuing in U.S. dollar terms. And depending on your investment horizon, If your investment horizon is 1 year, then the risk-free rate has to be your 1 year Treasury rate. Look at the yield curve, 1 year over here, right? Yes, 1 year. If your investment horizon is 10 years, then this should be your risk-free rate. If your investment is like a 30 years bridge building project, then or project finance, this will be your risk-free rate, 30 years. Matching has to be there. Now, let's move on to the next slide. Before we move further into the calculation of risk-free rate, I want to give you some more historical background of U.S. Central Bank, Now, United States, very interesting. Why do we care about it? Because this kind of structure is quite prevalent, especially in Korea. We had so much influence from the United States, so that the Bank of America formation, a lot of it was influenced by U.S. government. We learned from the U.S. system. Now, interesting thing is, the United States they did not have a central bank until 1913. Okay, of course there were some kind of 20 years into they had some Bank of United States or something like that in George Washington era or something, but they did not actually, in effect, they did not have central bank until 1913. Okay, why? The founding fathers of the United States hated the constant concentration of powers. For example, in Declaration of Independence or Federalist Papers, if you read those things, right, that part of the history, they had this kind of philosophy. They are coming from the Europe, but they wanted to stay away from legacy system of Europe, ancien regime, or anything that is corrupted because of the absolute power of absolute monarchism, right? We want to stay away from that, and then we want to create our own democratic capitalist experiment in this newly found land. So absolute power corrupts absolutely. So let's prevent centralization of any power, and money especially comes with power. Money is power. Okay. So anybody say central bank, and they will say no, hell no. Concentration of money means concentration of power and then economic power, right? We're gonna stay away from that. So that's primary reason why the United States did not have any central banks. Plus, and then they had, let's say, fair market system. Now, their original intention was kind of sound in the sense that they need always a check and balance so that nobody gets corrupted and then stay competitive, right? In the market system. But what was the consequence is another interesting story. Let's say fair market system means like no government intervention, okay? 자유주의 kind of things in Korean terminology. So what happened? Well, throughout the US continent, right, tens of thousands of small banks, local banks emerged and competed, right? Like a perfect competition. Nobody can influence the market, so that everybody is price taker, as in economics 101. They started small. Everybody started small, and then one after another, actually, if you leave it untouched, right? Some guys maybe more competent, maybe more lucky, they take over some less competent guys or unlucky guys, right? And then by and by, banks merge, and then their size goes up. Okay, so that's what happened later on. Okay, and then before that, when tens of thousands of small local banks competed in 19th century or 19th century early, each created their own paper currencies, so much so that there were 10,000 different kinds of banknotes. 만원권, kind of $1 bill printed by all different kinds of banks, right? Looking different, and different faces over there. Okay, can you imagine that, right? Especially before the Civil War. After 1865, almost like two kinds, North and South, but after 1865, it converged to one, I guess, right? And then the thing is, as you leave the competition in the market as it is, money begets money, so that the more competent guy takes over the less competent ones, and consequently, J.P. Morgan emerged as the almost monopolistic power in finance, right? Is that J.P. Morgan that we hear in J.P. Morgan Chase? And that's yes. Is that related to Morgan Stanley as a top investment bank these days? Yes. How come they stem from the same root? That was J.P. Morgan. Okay. Now, a little bit more of the history. Okay. So what happened in the market in the US during that 19th century and early 20th century? Okay, let the market go on, and then there will be booms and busts. Business cycle goes on. Okay, business cycle goes on. There's a repetition of boom and bust cycle without government intervention. The trouble was that during the bust cycle, which happened almost like every 5 years or 3 years, bank runs frequently happened with some self-fulfilling rumors. What do you mean, bank runs? Let's get back to this picture. Wait a minute. Right. So what was the bank run idea? Okay, bank run. So here, okay, here's another one bank, or here, let's see, this bank, a poor bank. Okay, some poor unfortunate bank was there. Okay. For example, in 1906, some banks invested heavily in San Francisco's copper mining company or something, was devastated because the copper mine was doing no good. Okay, San Francisco economy was really bad during that period, and then though that bank, right, was in trouble because of that poor asset in their bank, right? Now what? The depositors, right, not just one guy, but many guys, right, were concerned, right? Oh my God. You know what? This bank is devastated, so that they will be insolvent, which means they don't have enough of a reserve. Okay? Reserve? Wasn't it related to Federal Reserve over there? Right, but in 1906 there was no such thing as central bank. No reserve over there. So what do you do as a depositor? They spread rumor and say, it seems like the bank is in trouble. Before it goes bankrupt, I want to pull my money out. Run to the bank and then, give me my precious deposit money. And then not only you, but also all the depositors flock like the picture that you see in your slide, and then bother the bank like crazy. Then the bank has nothing but, has to go bankrupt, right? That's the nature of bankruptcy, okay? So this one is economically driven bank run, by the way, because it was affected by, San Francisco company's poor performance. But what is troublesome is the domino effect. Okay, when this guy lent money to San Francisco company, this guy must not be the only one lending money to this San Francisco company. Let's say that. Okay, San Francisco company. But other banks, I don't want to use Bank of America over there because I worked there. Some other bank. Okay, some other bank lent money to San Francisco company, all different kinds. Banking network matters. Just like the contagion of this virus. Your friends with money, bankers' friends are bankers. They lend money to this, they lend money to that. As long as this guy is busted, not only this guy, but also the other guys must be in trouble. So what does that happen? Well, these guys spread, concerns to the depositors on the other banks, and these guys experience another bank run. Okay, so the bank run has this kind of contagious nature, so that the bank fails in a domino fashion. Okay, domino fashion, which is not good for the economy. We call it financial crisis. Okay, up to the degree that some banks, okay, again, this kind of bank that has nothing to do, happens to be nothing to do with SF company or this guy troubled bank, they still may get affected by simple rumors. Somebody spread rumor that, a false rumor or fake news that, that bank may be in trouble too. then they will experience bank runs and eventually bank failure will happen, devastating the whole economy. Okay, 1906, that was the situation. Okay, huge economic depression happened. Now, at that moment, who was saving the system, whole economy? Told you there is no central bank. There was no central bank. But then JP Morgan was saving that situation. JP Morgan was the biggest financier of the United States, and he was going through all, he has good information about all banks, right? And well networked and well resourced, biggest one ever. So what did he do? He said, he was, essentially worked like a central banker in 1907 panic, rescuing healthy banks from the domino bank failures, right? So he was saying that, oh, this bank, this one is safer. We're gonna keep it, okay? Don't touch on this one. No worries. The other guys, they are troubled banks, so you die, and then these guys, you live. Essentially, this guy was working like a central banker. You live, you die. You live, you die. Can you imagine that? One person determining the future of so many different companies and economic system. One single person, right? That was JP Morgan that you see on the picture on the right-hand side. Okay. Now what? What was the purpose of not having central bankers? To avoid exactly this kind of situation. So one of the guys who was involved in that kind of, JP Morgan's decision-making table, right? Paul Warburg watched that situation and said later on, we need a central bank on our own, right? Let's devise it following some European framework, okay? Bundesbank kind of ideas, I guess. Anyway, because he's from Germany, right? Commercial banks, let's say this idea was like this, okay? These commercial banks would be the shareholder of this central bank that we create, okay? So let's put it this way. Draw a picture like this. Can you see it? Now, central bank, I told you, it also has balance sheet. Okay, balance sheet. Over here. Okay, bald eagle, balance sheet. I don't want to bother you, bald eagle. So, central bank. Okay, I'm gonna state it again here. Okay, can you see it? Right, like this. Okay. Let's create a central bank, okay, whose equity holders are the depository institutions that we have in the country. So the equity side, you have ownership coming from all different banks, okay, ownership, right? This is like Bankers Association company, right? And then what do they do? Well, let's host government's deposits that come from taxpayers' revenue. So again, deposit from the Treasury, right? Treasury, the taxpayers' money. Okay, based on this, you issue currency or do whatever monetary policy later on. And another thing is, let's keep the central bank as independent from the influence of the government. The government, this guy, as well as the president. Even though you host the deposit from the Treasury, you try to stay away from that influence. Central bankers' independence is important, they say. Why is it important? The question is the objective of the central government, right? The President Trump kind of guys. What do they want to achieve to get re-elected? GDP growth, right? Economic growth. Xi Jinping, what does he want? China's economic growth, GDP growth. You don't want to screw that, right? So the central government's objective is to maximize, increase the GDP growth percentage. Okay, government. But how can they easily achieve it? Of course, we want to be truthful so that the real GDP will increase, okay, instead of inflation or other factors, right? GDP, real GDP. But they can just increase nominal GDP while sacrificing the real GDP, which means triggering a lot more inflation. Inflation happens when the economic boom happens, more expansionary setting, right? Money supplies more, and then the inflation takes off, okay? But sometimes the hyperinflation also happens, right? Without any increase of real GDP. So what does that mean? To achieve a certain level of GDP growth rate, nominal GDP growth rate, they can print money. The central government may influence the central bankers and say, print more money so that the GDP growth rate will go up. And then the central bankers should be resisting about it. Let's keep it independent. That was the goal over there. Okay? Right. The next is about, let's see. Yeah. Federal Reserve Board was therefore born with this kind of plan, right? With this kind of plan. Let's make it independent from the central government's influence. They had a kind of objectives over there. Their policies, the Federal Reserve, is they have a monetary policy, okay? And then their function is to realize financial stability, because if the financial market goes into trouble, boom and bust, like what I said before, dominoes of bank failures, that creates a disaster for the whole economy. The people will revolt against the government and topple the government, and then the revolution may happen. We don't want that, okay? So we have to stabilize the system through financial stability. So that's the function of the central bank. And then it works as a lender of last resort. As I told you before, some troubled banks come to the discount window and say, you know, please help me, lender of last resort, okay? And then let me come back to that monetary policy. Okay, monetary policy over here. It's about the price stability. Okay, you don't want too much inflation. Hyperinflation, it's miserable for the whole national economy. That's what happened in 1930s or 1923 or Germany or something, right? Hyperinflation. And then you don't want deflation either, because that's when the macroeconomic contracts like crazy, okay? Isn't that something that we are experiencing? I'm afraid so, right? Price stability is their objective. And what is interesting in the United States Federal Reserve is that they have equally important objective, which is maximizing employment, right? Maximizing employment. Why is that the case? Because sometimes overheating of the economy result in high inflation rates and high the high interest rates, right? To cool down, did I say high interest? No, high inflation rate. Okay, to lower down the high inflation rate, to cool down that situation, the central bank will try to do some contractionary of monetary policy that I describe later on. The contracting monetary policy will naturally slow down the economy so that the unemployment rate may jump up. Okay, you don't want that kind of social unrest coming with this excessive unemployment rate. So you want to have the balance of it, okay, somehow. So that's what makes the U.S. central bank interesting about it. Bank of Korea does not have explicit policy objective like this, but they have objective of price stability. Okay, and then for this monetary policy, what do they do? Well, they do open market operation. As I said before, they go to the bond market, U.S. Treasury bond market. Okay. With what money they got taxpayers' money, right? Cash, right? They used to have cash with this deposit, but go to the U.S. Treasury market and invest in those U.S. Treasury. Usually, as I said, short-term maturity Treasury bond, 3 months, 1 month T-bill, right? Well, if they buy U.S. Treasury bonds, right? If they buy U.S. Treasury bonds, then what happens in the bond market? They are such big hands or big guys, so that the demand for the bond increases, which means the price of the bond increases. And then there is an inverse relation between the price of the bond and then the bond rate or interest rate, because this bond price or value will be R minus G. Relation will hold. Again, bond dividend or their cash flow discounted at their discount rate. There is inverse relation going on between these two, right? So that's why risk-free rate, bond price, right, goes up, goes down. Okay, price goes up, risk-free rate goes down. That's what is happening today. Okay, Fed funds rates, target rates goes down together with it because it is a short-term maturity one, and they are targeting at that one. So the influence happens in that direction. On the other hand, when the central bank sells U.S. Treasuries, what happens? Their bond supply, bond supply increases, which means the price of the bond goes down, and due to the inverse relation, the risk-free rate will go up. And together with it, the Fed funds rate, their target rate, is going up. Okay? And this will cool down the economy. And how does it cool down the economy? It's more difficult to borrow money, simply put, right? Higher interest rate, no more business. Okay? That's why. No more consumption. Anyway, so that's monetary policy. What's the distinction between monetary policy like FOM's open market operations and then quantitative easing? As I said before, QE is about long-term bond buying and selling with specified amounts committed. They say it, announce it. $700 billion we're going to spend. But in open market operations, they don't say it. Our intention, maybe Alan Greenspan was good at this one. He never specifies anything, like nail down a number. No. It's kind of, you have to get the sense of it, right? So in the short run bond, they'll be like, so that's the thing. Central Bank of Korea, you see the building, which was built during Japanese invasion era, 1910s or 20s, right? And then nowadays it is used as museum of currency in Korea. And then the building right behind, the tall one, is the current central bank building. Now, Ministry of Finance or Treasury of Korea, that building is in Sejong시. Lee Chan-hee is a GBA graduate who is going there. I mean, he was a student right now. He's going there. So congratulations. I hope he succeeds over there, right? Here at Daejongbu. Now, base rate of Korea, okay, is shown over here. We call it repo rate, repurchasing agreement. So it's like a short-term overnight borrowing rate among these banks, right, in Korea. So it's something we specify the central bankers in Korea, okay, work on this one. And together with the Jerome Powell's movement, right? Bank of Korea also decided to lower down this Korea's base rate to 0.75%. Risk-free rate, the concept of risk-free rate, we're going to go through it, okay? And then I told you already enough about the US Treasury rate, so you can explore this website yourself and then answer those questions. And then some of them, like last one, will be more open question. What's the difference between Korea Treasury rate and the US Treasury rate? In what aspect? Please think about those things. Risk-free rate, the concept, right? And how to obtain it is an important issue we're going to talk about. Again, right? The market is in such a turbulence these days, so much so that yesterday when I was recording my first portion of this video of week 4 lecture, okay, I picked up those news articles about Fed chair's announcement that they were going to lower down the target Fed funds rate to 0%, and then they will do more quantitative easing of $700 billion, right? Purchasing US Treasury securities and then pumping more money. And still, the market tumbled down so that the S&P 500 index plunged by about 12%. And I told you that monetary policy is not enough in this case because the coronavirus is not really about financial market itself per se, but it's about the real economy, right? So you need some fiscal policy to stimulate these consumers to go ahead and spend their money. And then you need to rescue those companies in trouble, okay, that is directly hit by this coronavirus, especially travel industry, airlines industries, and then you name it, right? And I said, would the Donald Trump administration be able to implement a very drastic fiscal policy, so of giving money to everybody or rescuing companies, like directly giving them money? Yeah, because this is a very conservative, supposedly, government, and then giving money and then suffering, expecting or going through some fiscal deficits, right, is something those democratic governments are pursuing it. That's democratic style, right? But overnight, what had happened was very surprising to the degree that I was wondering whether I should take my record my video lecture once again, okay? But I decided not to go through that part because I was recording time and time again yesterday, even to the degree of going to bed at like after midnight or something, right? Crazily recording. So I decided to take it as it is, right? And let's see what happened overnight. And Dow rebounded more than 1,000 points as Trump seeks $1 trillion in stimulus for coronavirus fight. And essentially, they implemented actually what I was wondering, right? Actually, what I was wondering came from, who is that? Greg Mankiw, right? So, he is a Harvard professor, macroeconomic guy from conservative think tank kind of groups, right? The most genius guy in that conservative economist, right? And it seems like Donald Trump's administration was accepting his argument, and then let's do it, right? And $1 trillion, right? They're going to spend to, stimulate those economy, right? Giving money to everybody, and then $1,000 every, for 2 months, right? And then go ahead and spend it, right? And another rescue plan is like purchasing those CPs for the companies, right? CP, commercial paper. This is a short-term borrowing, IOU, right? So that's directly of helping those companies in trouble, because they have to repay those CPs immediately, right? No matter what. But the government is helping them, right? I'm going to do it for you, okay? That's what this fiscal policy can help, right? So that was good. And the thing is, the day before, market plunged by 12%. Now, why didn't it recover, okay, fully? So much so that maybe you would have 13% rebounding, but only 5% rebounding happened, okay, rebounding halfway. Well, there's still uncertainty about this virus, right? The degree of contagion, and then another thing is international cooperation, right? In a coordinated manner. The thing is, whether European government will follow this suit, or Korean government or Japanese government, right? Will they do a similar policy, fiscal policy, is in question, right? In a coordinated manner somehow. Korean government, unfortunately, so far, they seem to be reluctant, right, to implement this kind of things. I don't know why, okay? The thing is, the Korean government is more left-wing right now, more democratic style in terms of American politics, right? So they are, they can argue for more fiscal deficits and then bigger government role, but they are really afraid to implement that right now, announce that. Why is that the case? I don't know. Perhaps they have been arguing, they have been trying to implement more democratic style policies long before this trouble, so much so that they got so much criticized, like 소주성 we call it, or for example, let's increase the minimum wage from 7,000 won per hour to 10,000 won per hour in a couple of years or something. Drastic increase in minimum wage in a crazy way, okay? That was criticized so harshly by other political parties and all the people in the country. So much so that they may think that their ammunitions are gone. Okay, they ran out of ammunitions. If they try to argue more liberal fiscal policy, they would stand no chance of getting elected in the this general election coming in April. Maybe they are too afraid of it. That's my guess, right? Random guess, you can say. But the Korean government can be more courageous, I guess, okay? Following the US case. Even the most conservative Donald Trump administration is doing this, right? Why don't you follow it, okay? Instead, why do you have to wait until the United States doing it and just be a follower instead of being a leader? Come on, right? That's something I was, wondering. Anyway, so risk-free rate, yeah, that is something we have to, we'll finish this lecture, okay? Now, the concept of risk-freeness and then how to obtain those risk-free rate in your valuation, I'm going to talk about it. Concept of risk-free rate is this. Let's expand this screen. Yeah. Essentially, to be risk-free security, right? You have to have two features over there. One, those borrowers, okay, or the issuer of this security has to be really default risk-free. For sure, the entity has to be, 100%. It will repay the debt. Okay, are you sure? Okay, do you trust them? Okay, if yes, that's risk-free. But if not, if there's a slight chance of going bankrupt, track record, right? Then no risk-free. In bond market world, right? There's a credit rating going on. Okay, those rating agencies like Standard & Poor's and Moody's and Fitch, IBCA, or Dagong in the China, right? Their job is to rate those issuers of bonds, okay, issuers of bonds, about, how trustworthy is this entity. If it is the best credit quality, then they say this is AAA organization or company. If not, it goes down to AA, single A, and blah, 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 right? They rate those credit rating not only for the companies, but also for the central, the treasuries of the government, right? US Treasury, Korean Treasury, or European treasuries, or Japanese or Chinese treasuries. They rate all those things, right? So if it is AAA rated, then we say that's default risk-free, okay? That's one feature. The central government, usually the AAA central government, they are AAAs, right? The default risk-free, I say. Why is that the case? Especially, right? Because they can print money, first of all, right? They can print money. And local governments, typically, in local currency terms, for example, Korean government, Korean Treasury, right? Are they AAA? In US dollar terms, Korean Treasury is not AAA. Okay, so it's not default risk-free. But in Korean won terminology, right, or Korean won denomination, right, are they AAA? And yes, in local currency terms, Korean government treasury is AAA. Why? Because in the worst case, Korean government can print money themselves, right? And then here is our $1 trillion, I repay you, okay? Not dollar, 1 trillion Korean won, okay, 1조 won, $1 billion. I repay you with Korean money over here, Korean denominated debt. They can repay it for sure. But what's the downside of it? Well, printing their own currency at their own will, okay, that can create some hyperinflation later on, right? So the government, local government, they have to, consider whether they should really print money and to repay this debt or declare bankruptcy on their own, okay? To avoid hyperinflation situations, some governments say, I'm not going to repay the debt this time. Sorry. Okay? That happened in Russia in 1998, right? Putin or Yeltsin, right? The Tsar, right? Who can say anything against him, right? Especially in the Russian border. Russian ruble denominated debt, they defaulted. 배째 in Korean terminology, right? Nobody can 배째 them, right? 배째 means like cut my throat or something, like cut my, open my belly with your knife. Nobody can do that, right? So that's why. Russian government's local currency treasury is not AAA, right? And anyway, so default risk is that kind of things, right? Whether you can 100% repay or not. And then second one is about no reinvestment risk. And people or students often get confused about this concept. What do you mean, no reinvestment risk? Okay? Essentially, easily put, zero coupon bond is no reinvestment risk security. But here's the idea, okay? Let me expand this screen for you, right? Okay, so this part. Now, all right, this is the investment horizon, for example. So let's say this is 10 years, and this is 0. You're standing over here. Hello, right? Here, you put your money into US Treasury, okay, US Treasury, 10-year security, okay, and zero coupon bond, or we call it ZCB, is the one that does not have any coupon. In What does that coupon mean, you may say? It gets back to your Finance 101, okay? In Finance 101, what did you learn? You learned about bond valuation. Bond or 국고채 in this case, in Korean terminology. What do they have? Bond has two kinds of cash flows, right? Two kinds of cash flows. One is a principal, right? A principal or 원금 that you get repaid at the end of the maturity principal. And the other is coupon. Coupons. Coupon. Yeah. Why is it called coupon? Because in the history of bond, they were, how do you say, written like a bond principal. You at the end of the bond looks like this, right? The printed bond looked like this, so that the investors get the whole piece of paper, okay? When they initially put their money, let's say, for example, $1,000, right, over here, okay? Put their money, and then instead they get this piece of paper, okay? Whole piece of paper, but it has this kind of coupon thing, okay? Coupon thing, so that you can cut it, right? Cut it, this part, and then every now and then, every 6 months, okay, or every promised period, you come to the borrower, bond issuer, and say, here's my coupon, pay me the coupon, the promised amount. For example, $5 every $5, you get paid $5 of coupon, $5, blah, blah, blah. Remember this coupon? Yes. So the bonds, this is why they were calling it as coupon, right? You cut it, every piece, right? At the end of every period, and then get paid. That was coupon. Zero coupon bond means there's no such thing, okay? Nothing like coupon, only the bond, principal, IOU is there, okay? So much so that there's no intermittent cash flow, right? But the only cash flow that you have is the principal that is that the guy will repay you at the end of 10 years, right? So that's the zero coupon bond, right? Now, if it is a coupon bond instead of zero coupon bond, what kind of risk is there? We say reinvestment risk, okay? $5 of coupon, if you have some $5 coupon, okay, right? And of course, $5 over here. But think about these cash flows, right? When you put your money over here, in the beginning of the investment, there must have been some yield to maturity, YTM. Do you remember this? Yield to maturity. This is your expected return if you hold this bond until the end, until maturity. How much would you yield? Would this investment yield to you? That expected return, okay, holding until maturity. That was available in this at this point of initial investment. The thing is, this yield to maturity fluctuates over time. So, for example, in your initial investment time, the yield may have been 2%, okay, on the day of investment. So if you hold it until 10th year, right, then you will get 2% yield, a 2% return, expected return, okay? But depending on the market interest rate, right, this yield to maturity fluctuates, okay, so much so that maybe the second coupon payment over here, right? Okay, on the day of receiving $5, is there guarantee that your yield will be again, okay, if you reinvest, okay, if you reinvest these $5 into any security, okay, you got $5 cash, but on that day of reception of $5, can you reinvest at the same 2% yielding security? Okay, can you reinvest this $5 into any treasury or kind of similar securities that yields 2% if you hold until the remaining period? Okay, there's no guarantee about it because the interest rate fluctuates over time. Okay, maybe different, will be 99.9%. The interest rate will be different. So that's why there's always reinvestment risk about this intermittent cash flow coupon. Okay, so for coupon bond, U.S. Treasury coupon bond, in a pure sense, they are not the risk-free rate that we want. Okay, what we want as a risk-free rate should have no reinvestment risk, no uncertainty about this, whether this intermittent cash flow will have same expected return that we had before. Okay, so that's why we focus on zero coupon bond, because those guys, they don't have intermittent cash flow in the first place, and then until the end of the period investment horizon, we can see what's the risk-free benchmark that we really have. And why do we have to say this? Why do we have to impose this no reinvestment risk idea? Because our assumption in investment is that, well, if it is 10 years, right, then what we are assuming is that our risky investment, we are going to hold until 10th year. We are not going to sell off or partly sell off anything in the middle of the investment horizon. So our assumption is, we're going to hold our investment for a long time or a specified time period. Okay, the specified time period can be 10 years or 30 years or just 1 year or less than that. So during that, depending on your investment horizon, okay, for that investment horizon, go find out some zero coupon bond, the U.S. Treasury, okay, that matures in a specified period. That's my explanation. All right. So U.S. Treasury, if you are valuing any company in U.S. dollar terms, yeah, American companies valued in U.S. dollar terms, your risk-free security will be U.S. Treasury zero coupon bond. Number two, if you are valuing non-U.S. companies, for example, Samsung Electronics, Korean company, if you're valuing it in U.S. dollar terms, still your risk-free rate benchmark would be the same U.S. Treasury zero coupon bond. Why? Because there has to be consistency with respect to the currency that you are valuing at. Again, Korean companies or Japanese companies, Toyota Motors, if you're valuing it in US dollar terms, your risk-free benchmark would be zero coupon bond, US Treasury. Okay, the currency consistency has to be there. I'm going to test you in the final exam, right? Also, here in Euro currency regime, okay, here's an interesting question. Okay, Euro area, European Union, right? So here's a question. You're valuing Banco Santander in Euro currency. Yeah, I have to sound more like Spanish. Banco Santander. Which of the following should be the risk-free rate, right? Risk-free rate. Banco Santander, that's Spanish bank, right? Spanish bank. Very interesting one because Spain and Korea, the country's GDP and then those economic size is quite similar these days. But interestingly, Korea doesn't have such a global bank like Banco Santander, whereas Spain has Banco Santander over there. all around the world, right? Very amazing one, very interesting one. Let's see. You are valuing it in euro currency. Okay, you are valuing it in euro currency. And which of the following has to be the risk-free rate in this case, right? 10-year euro 10-year euro bond rate as of January 1st of 2020 is given over here. The thing is, in euro currency regime, okay, you have all different countries, their own central bank, and not only central bank, I would say what? Their own treasuries, right? Their own treasury department. The German government, Finland government, Austria government, France, Belgium, Ireland, Slovenia, Portugal, Spain is there, Italy, and Greece are there, right? Right. Which of the following treasury rate has to be the risk-free rate when you're valuing Banco Santander in euro currency? Right? Which one would you pick? The answer, what did you pick? Did you pick Spanish rate of 0.48%? Or did you pick, I don't know, Greek rate of 2.08%? Did you pick German rate, which is negative 28 basis points, or 0.28% minus? Or did you pick France, 0.03%? Which one has to be the risk-free rate? Okay. The answer is German rate. Okay. In the same currency regime, go for the lowest possible rate, treasury rate. Okay. So even though it is a Spanish company, as long as you're valuing in euro terms, the treasury rate of the lowest treasury rate within that currency regime has to be the risk-free rate. Okay, I'm going to ask you this in your midterm exam. Why should it be the lowest rate over there in the currency regime? Because you have to go for the safest treasury in that currency regime. Okay, that should be your benchmark in valuing as a risk-free. If I invest using in the euro currency, right? Where is the most risk-free return that I can get? Okay, that should be my benchmark as a starting point, right? And then, as long as my investment is risky, I'm going to add risk premium later on that is correspondent to the riskiness of this investment. But first of all, I want to start with the risk-free benchmark. Okay, the safest asset in that currency regime. In euros case, you have Germany over there, right? So go for it, right? So German is minus 2%, like this, right? You may be troubled in your mind, right? That's minus rate. Come on. Is it still okay to do that? In Finance 101, we learned typically, right, those discount rate was always positive. We never thought about, minus interest rate before, right? Minus interest rate. Is it still okay? And the answer is still okay, yes. Don't worry. Go ahead and do it, right? But I'm going to say why about this later. So 28 basis points over here, right? Right, that should be your risk-free rate that to start with. And R for Banco Santander, right? It's not BS, doesn't stand for bullshit or anything. Banco Santander. You start with this risk-free rate plus there's going to be some beta, RM minus RF will be there for you in capital asset pricing model. Okay, Banco Santander again. Okay, like that. The risk-free rate being minus does not necessarily mean that the whole discount rate for Banco Santander will be minus. Don't worry because you have this guy, You will have this guy later on. Okay, so don't worry. People feel so much uncomfortable with doing this, right? But don't worry. Negative risk-free rate, is this okay? What the heck is going on? You may wonder, right? And the world is full of, surprises. And then, like, there are so many things that people initially imagine that's unimaginable, right? For example, in BTS, right, 방탄소년단, right? When I was in your age, right, I never imagined that Korean singers will be that popular in the whole world. But unimaginable things happen. Okay, that's not the only one. When I was in your age, Lehman Brothers and Bear Stearns, that kind of companies, I thought they would never go bankrupt. Happened. It happens. Now, and then another thing is risk-free rate being negative, okay, or interest rate, nominal interest rate, and that, right? Nominal interest rate being negative. By not only myself, but also my professors, finance professors, okay, told me before, nominal interest rate going negative, nah, unimaginable, right? It's not going to happen, don't worry. But it happened. It's happening, right? Why is this thing happening? Gets back to this nominal interest rate is equal to what? Nominal interest rate. Gets back to your economics 101. Do you remember Fisher equation, right? Yeah, Fisher equation looks like this. 1 plus nominal interest rate. I say RF instead of R because I want to, focus on this risk-free rate, okay? Treasury rate, risk-free, okay? Nominal and risk-free rate, okay? Equals 1 plus real interest rate times 1 plus what? Expected inflation rate, okay? At least by investing in risk-free security, you want to get covered as much as the inflation is coming up, right? You want to do better than inflation. That's why 1 plus inflation is there, and then we multiply 1 plus real risk-free rate, okay? Real risk-free rate. And if you do the math and then realize that the multiplication of real RF times inflation rate is such a minimal magnitude, minimal number, you ignore it, cross it out, and then in an abbreviated fashion, we say what? Nominal rate will be equal to real rate plus inflation rate. Okay, inflation rate. The intuition, I told you about it before. You want to get compensated more than inflation, and then the real risk-free rate has to be there to make your nominal interest rate over there. Now, one trouble may be when you don't have a good information about the real risk-free rate. Okay, when you don't have good information about real risk-free rate, what should be it, right? What should be your approximation? Well, real dollar, real GDP growth rate could be a good benchmark. Okay, could be a good benchmark. Now, what's the idea there? Real risk-free rate. Real risk-free rate. RR is equal to almost growth rate of real GDP, right? What's the intuition over here? Well, your Treasury, okay, Ministry of Finance, they can promise to give you some interest or return to you as long as there is some real GDP growth rate is there. As long as there's economic growth in your country, this is the rate that the Treasury can repay or the promise to return to you. Okay, in real terms. Put another way, for U.S. Treasury or the country's Treasury to be able to return something to you in real currency terms, okay, they cannot promise more than what the real GDP is growing in their country. That's the idea. Now, having said that, we move on to the next slide, which is about negative interest rate, and that negative nominal interest rate. Okay, you look at this one, then you realize that this real risk-free rate can be negative. When this guy is negative, when your country's economy is shrinking, right? There are old-time empires that were used to be very, very big. For example, Austria Habsburg empires, that kind of things. Sometimes they shrink. The GDP may be shrinking. In that sense, their real risk-free rate may have been shrinking, right? So that's one possibility, right? So real risk-free rate being negative, well, it can happen. But for nominal interest rate, okay, typically you are saying, nah, that's almost impossible or unimaginable, they said, right? Why? Because there will be inflation, and then rational people will always want to get covered better than this one. And then, so easily put, why would you put your money to a bank when the bank charges you even more? Okay, so nominal interest rate being negative was something unimaginable before. Okay, but it's happening. So next slide over here. In 2020, right, there were at least 3 currencies, Swiss franc, Japanese yen, and euro, with negative interest rates, and perhaps 2 more, Croatian kuna and Bulgarian lev. Bulgarian currency, wasn't it Bulgaria or anything? No, Bulgarian lev, right? Using the fundamentals approach, right? How would you explain negative interest rate is a big question, right? And then would you use, how negative can it get is the next question. And then would you use these negative interest rates as risk-free rates, right? Risk-free rates. If no, why not? And what would you do instead in the valuation is a question, okay? And if yes, what else would you have to do in your valuation to be internally consistent, okay? Actually, the second half of this slide covers the part. It's a kind of a preview of what you're going to do in your valuation preview. All right. Now, negative interest rate, right? How can it happen, right? How can it happen? Damodaran's answer is that maybe it could be irrational response of central bankers. So let's get there here. So it's about, first of all, inflation rate, right? When can a negative interest rate can happen, okay? Maybe because expected deflation, where the inflation rate is very, very negative, right? So much so that you can't help this guy, so that the negative things happen, okay? But even if there is no deflation expected, things can happen, okay? Things can happen. So when? Sometimes those central bankers are pressured somehow, or maybe they are overconfident, so much so that they could, stimulate the economy so much using this monetary policy. I told you about this using the immediate example of U.S. Federal Reserve trying to push the Fed funds rate down to 0. But that's just the beginning, okay? In Japan, right? They were pushing down, the central bankers were pushing down those interest rate below 0, right? To stimulate the economy, to stimulate or pump the money into the system somehow, right? And then, this how much effective is that kind of policy? Monetary policy is an issue, right? Maybe the central bankers are overconfident so much so that their monetary policy will be effective in pumping the money so that the economy will be stimulated somehow. But in the end, that may not be effective. Okay, we have to be careful about that. And then getting back to the intuition about this negative interest rate over here, nominal rate. Okay, why would I put my precious money, let's say $1 million? Oh well, why would I put my money into the bank deposit account even when they say they charge me more money for my $1 million? Okay, minus 0.5% interest will be charged upon this one instead of 0.5% interest I get. Okay, it's like, hey banker, please, I will put my money into your safe, please, and I pay you more. Thank you for keeping my money. Instead of the banker saying, thank you for bringing your money to my account and then, increase my performance over there for hosting more deposits, right? Very interesting situation. What's the alternative, right? What's the alternative? My $1 million. If not for bank, I should put my money under my, mattress, right? Or into my closet, right? $1 million. I must keep it, right? In that case, I would run the risk of what? Getting stolen by, I don't know, somebody, right? The thieves or whatever. I'm afraid. So it's not safe, right? If I keep it over there. So instead of doing that, keeping it under my mattress, I may just put my money into the depositor account, right? And say, thank you for keeping this for me, and then I pay you more, right? Down and out, this kind of situation is happening. And then this kind of things, right? Cash, holding cash these days, right? Is it holding cash or under my mattress? It's not only unsafe, but also it's inconvenient, right? Inconvenient in what sense? Let me ask you this question. Who used cash to pay for your grocery these days over the last week, right? Drinking your coffee or, going to the restaurant or whatever, okay? How many times did you really pull out your cash out of your wallet? For me, no, okay? I've been using my, bank card, right? Bank card. The digital transaction is so convenient these days. You don't really need to hold your cash. It's more costly, right? Moreover, coronavirus, okay? It says that the currency is a carrier or the worst carrier of this coronavirus because it's changed hands, right? From one person to the next. God knows what will happen. The other day, I was trying to give my children their pocket money, like 주급 or weekly pocket money of a certain amount using cash, right? And my wife was almost killing me. Don't give that cash to my children, right? Because it carries that virus. So I was like, nah, okay, right? But just once I gave them, right? I'm constantly convincing my children to have their own bank account, right? One of them is still refusing to have a bank account because she doesn't trust bankers. She was too much influenced by the YouTube fake news, right? But this is a chance that I can convince her for the safety issue, you need to have a bank account, right? So, it's not only convenient, it's safer these days. So why can't we just pay the fees or negative interest, right? Undergo this one, okay? Thank you for keeping my money over there and making my transaction safer. Okay. Anyway, so that's one thing I would say. This is helping, right? Um, anyway, so that's one reason why I would say there was a negative interest rate going on, and it seems like it's going to be there for some time. And how much can the negative rates go down? Okay, is there some bound on it? Well, to the extent that it helps our convenience, right? Maybe, okay? The transaction cost equivalent, it may go below at that level, but not that much, okay? Not much more than that, right? Would you use this negative interest rate as risk-free rate? Yes, of course, right? The thing is, in valuation, in finance, right? Those discount rates, like risk-free rate or whatever rate, you should use today's market rate, okay? I'm going to test you this in your I-Corp project as well, okay? And your final exam as well. Today's rate. Why should that be today's rate? Because you have to take the perspective of the investors in the capital market today. Okay, you're assuming as if the CFO goes to the market today and then asks the investors, "Would you invest in my company, please?" Okay, and then the perspective of the investors would be, as of today, what the market perceives, and then based on this, I will make a decision. And the starting point would be today's risk-free rate, not the historical average risk-free rate, because history is gone, thing is gone, man. Forget about it. Okay? That's it. And then you may still be wondering if this is negative, right? Wouldn't it be lowering down my risk-free rate too much? Okay? So much so that in valuation, right? Let me write down this up front here. Valuation R minus G. This being very small, right? Wouldn't it inflate this guy would be your concern. Okay? But I say no, don't worry about it. Don't worry about it. Just take it as it is, okay, until you face a real problem. Why is that the case? First of all, you have to ask yourself why this is negative, okay? Why this is negative? Primarily because the economic situation is in, what's that? Recession. Recession, that's when the people are very risk averse, okay? Who wants to go ahead and do their own business these days? Everybody's afraid, okay? Everybody's afraid. That's why the business or economic activity is shrinking, and that is why the central bankers are trying to do monetary policy to stimulate the economy like this, okay? Which means your cash flow expectation will be already small enough, right? And not only that, but also this market risk premium, okay, which is a function of the risk aversion of the market investors as a whole, will be big, So much so that this discount rate itself, would it be small uniformly, is a question in the first place. This one is negative, but this one's so big so that the resulting discount rate may go anywhere, could be even bigger. So much so that your valuation number may not be bigger, but it could be smaller, right? And add to that, this cash flow being smaller, expected future cash flow, right? Being smaller. So it could be even more negative. So don't worry, okay? So don't worry about using this negative risk-free rate right now, okay? Don't worry. That's my message. I'll move down to the next slide. Right. The next is about when the default risk-free entity is not existent in your country. Okay, Russia, right? There are 5 alternatives, right? Or many other emerging countries. I would say. I don't want to get killed by the Putin or anybody. Okay, don't kill me, right? Valuing in US dollar terms is one thing. Okay. Valuing in US dollar terms. As I told you before, if it is a Russian oil company, right? Still, if you value it in US dollar terms, your risk-free rate should be US Treasury rate. Okay, so you stay safe with that. Number 2, government Treasury rate minus its own default spread. Okay, could be your alternative when you're valuing in your local currency. Okay. Number 3, using interest rate parity relation to infer your country's risk-free rate. Okay, the idea is to get to the true risk-free rate if it should exist in your country. So that's why we are inferring it. Number 4, using real risk-free rate of the US for your country and valuing in real terms, right? So the idea is assuming perfect capital market, frictionless capital market, real and then well-connected global economy, right? Well-connected global economy. Then the money will flow following the real economic growth rate, okay? So the real risk-free rate of the US will be ubiquitously used in any other countries. If not, they will flow to the real risk-free rate regime that gives a higher return. But assuming a very strong assumption that the global economy is well connected, you can use number 4 approach. Number 5, long-term GDP growth rate of the economy would be good enough for you. I mean, that's easiest, okay, in that case, right? So 5 different approaches are there. One by one, we're going to go through, so wait for that. So when default risk-free entity does not exist in your country, okay, you're in trouble, right? But number 1, when you're valuing in US dollar terms, for example, valuing Samsung Electronics using US dollar terms, right? Or valuing Toyota Motors using US dollar terms instead of Japanese yen. Well, life is simple. Just use US Treasury rate as your risk-free rate. The only concern you will have later on is just make sure you convert all your currency units into US dollar instead of Japanese yen or Korean won or whatever, right? Number 2, valuing in local currency. Okay, local currency, for example, Toyota Motors in Japanese yen, okay, or Hyundai Motor in Korean won. Then the trouble is this: the government is not AAA, Japanese government single A, Korean government double A. The risk-free rate should be something different over here, okay. The trouble is, seemingly in local currency terms, your government treasury is AAA. Korean government in Korean treasury rate itself is AAA, but that's not truly risk-freeness, right? That's not truly a risk-free because that's not truly risk-free in the sense that they will be able to repay in whatever sense in US dollars or whatever currency or whatever situation. It's just a AAA because they have the ability to print money, and then they usually have not been defaulting to their local currency debt yet. But there is some chance that there may be still a bankruptcy of this government, no matter what country it may be, as long as your country is not AAA in US dollar terms, right? Korean government, right, for example, or Russian government or other emerging market governments. So the idea over here is to estimate the true risk-free rate. Okay, true risk-free rate of your local government's local currency. Okay, we are being very stringent about it. Okay, true risk-free rate. Now, yeah. The thing is, local government or your country's, Korea's government treasury rate must be available, right? Some percentage, let's say 1%, right? Point. Then this is not that 1%. Let me write it down over here. Korean government local currency treasury rate. Let's say that's 1%. Okay, but that is not really true risk-free rate because the Korean government still has a chance that in the future they may declare bankruptcy. Okay, in the worst case. So what is their risk? And then associated with that risk, there must be some default spread associated with it. So we're going to take out some default spread out of it. Default spread. Yeah, to get to true risk-free rate of Korean government. Okay, so that's what we are going to do, right? How do we do that? To get to that Korean government's default spread? Well, it's kind of indirect. First approach is let's look at US dollar terms default spread of Korean government. Okay, that is emerging markets government bond rates. For example, 외평채 in Korean terminology. There is some Korean government bond issued in US dollar terms, right? That's emerging government bond rate in US dollars, right? And then from that you subtract the US Treasury bond rate. The difference over here should be Korean government's default spread. Okay, Korean government's default spread. And this is a good candidate of the default spread that we are up to over here. Okay, default spread that we are trying to get, right? You may say, oh, that default spread was obtained from US currency, US dollar terms, but as long as we are doing valuation in Korean won, isn't the Korean government's treasury rate is just good enough? In a very simple setting, you are right. In a loose sense, you are right. But I said we are being very stringent over here to estimate the true risk-free rate of Korean government in Korean local currency. Still, there may be some chance that the government may declare bankruptcy. So that's why we are subtracting the default spread. Okay. And then to estimate the true risk-free rate of Korea. Okay, now that is why we are doing the first approach. And then the second approach is to estimate, to obtain this default spread directly from CDS market. CDS is credit default swap, right? And then there is you will see a website that takes you to historical data of CDS spread of all different countries or entities that you are interested in. Okay, CDS historical data, that you see it. Well, let me scroll down a little bit. Yes. You're going to be able to see a sovereign 5-year CDS spread, okay, of all different countries. Why do we see a lot of red figures over here? Oh my God. Let's see, we're going to get to that issue later on. Right now, the default spread of South Korea is 51.49 basis points. Okay, so that's right. That's our 58. Where is that? 51.49 basis points, which is 0.5149. Okay, percentage point, 0.5149. 0.49 percentage point. Default spread or CDS spread is there. Okay. By the way, basis point means 0.01 percentage point. Okay, it's just a jargon in the financial industry to spook any non-finance guys. Don't get scared. Anyway, the issue is, what is CDS, right? CDS, credit default swap. Let me take you to the next slide first, and then we'll come back to number 3. Local currency government bond rate is shown over here. We're going to talk about it a little later. Let me finish the CDS spread first. Okay, CDS is the is a kind of insurance. Is a kind of insurance. For example, okay. For example, here's a Korean government. Okay, Korean government. Let's say they issued a bond. Okay, they issued a bond, or that means Korean government borrowed some money. Okay, in US dollars. Let's say. Why? To finance their fiscal policy somehow, or maybe they have a new social infrastructure project going on, and then for that financing purpose, they borrowed some money in US dollar terms, right? There must have been some lenders, like some banks and then insurance companies, right? They put their money. Okay, I lend you Korean government. Let's say KR. Okay, and here comes Bank of America, right? And then they lend you money, lend the Korean government money, okay? But they know that Korea is not risk-free, okay? There is a chance that Korean government may declare bankruptcy. Okay, I'm sorry, we cannot pay you as much as we promised before. That unfortunate event is kind of scary. So Bank of America, as a lender, what do? They go to insurance company, okay? Not really insurance company, but they want some insurance contract kind of things that cover this situation, so that when Korean government declares bankruptcy, this insurer or this, we call it CDS seller, or this contract seller, okay, or the contract counterparty, right, will repay that whatever amount the Korean government owes to the lender in such a case of bankruptcy. Okay, so it's covering a bankruptcy. Credit default swap, okay, is this kind of structure. But this insurer or CDS seller is not doing this job voluntarily without any compensation. They need some fees, right, or insurance fee, right? That is shown in the form of, so periodically this lender has to pay some CDS payment, right? They have to pay a certain amount very periodically to be covered, okay, nicely with this CDS structure. That payment is shown in the form of CDS spread, okay, percentage of their loans, right? In Korea's example, 0.0, what's that? What was that? In Korea's case, 0.5149 percentage point of principal amount the lender has to pay as a fee to the insurer. That's the CDS spread, which is the default, which is directly reflecting the default spread of the borrower. Okay, so getting back to our original slide, okay, this CDS spread, we use this as default spread. And the good thing about CDS spread is that there is an active market going on 24 hours, right? Up to date, real time. It reflects the default risk of the borrower, okay? So that's why we want to use default spread, best candidate, I would say. Before the CDS, the problem with CDS is that not all entities, not all borrowers have this CDS spread information, okay? The CDS market started only recently, like about 15 years ago or something, okay? Before that, it was only the bond spread, okay, bond rating, credit rating was the key determinant over there. So the number one over here, right, emerging market governments, right, bond rate, okay. For that part, this has been there for like many like decades, right? So for that part, right, you need to go for, and then the number three also, sovereign bond rating, right? Emerging market government bond rate and sovereign bond rating. This is a good info. It has been there as an information source for default spread. You can see from the following website, the tradingeconomics.com. Let me go there with you, and then assign the default spread for the relevant rating. So tradingeconomics.com, let's click it. Now, it takes some time, but, all right. Abracadabra, yes, it shows up. Now, what do you see? On the vertical axis, you see a whole lot of countries' names, right? On the horizontal axis, did I say horizontal, vertical? Yeah, horizontal axis, you see S&P, Moody's, Fitch, and DBRS, right? What are those guys? These are the credit rating agency that I said before. S&P means Standard & Poor's, right? So different rating agencies, their job is to rate and then evaluate the credit quality of the country, okay, in every quarter or something, okay? Remember, CDS market is real time, every day, every second. Right? Credit quality is assessed, and then the market participants trade on it, right? But decades ago, rating agencies have been working this for all different countries and companies as well, right? As long as these countries' treasuries have issued any bonds, right? Treasury bonds themselves, these S&P and Moody's have been rating those bonds and say how dangerous or how much risky is this government, okay? Let's go to Korea. Yes, let's go to Korea. Where are you? Where are you? Not here. Typically South Korea, Republic of Korea. It's always time consuming. South Korea, yes, over here. You see double A, and then double A all the way, or minus, depending on the rating agencies. They usually agree, and then they rate similarly with slight deviation. South Korea, double A, which means their debt, their government's treasury, right? The government budget situation is solid right now. The debt, government deficit is small relative to the GDP size, right? It's all about the deficit and then the government debt issue, okay? Similar idea goes on. The intuition is always how much, okay, can this government or can this company, okay, repay the debt with its own operating profit or operating GDP kind of, right, product within the country's economic activities, right? You want this debt burden to be small compared to your operating cash flows or GDPs kind of things, right? So that's the whole idea. No need to go more complicated issues, right? So South Korea, double A, Spain, single A, and what about Japan, our good old friend or rival country of Korea? That's single A plus. Woo, interesting. Why is that the case? I mean, Japan has been over there all the time compared to Korea in terms of economics, right? Why is Korea better rated than Japan? And some of my friends will say, yeah, then Korea is finally better credit rated than Japan, and it's like Korea versus Japan is like a rivalry going on, right? It's very interesting and funny sometimes. But why is that? Is it some party time for Korean guys? Like, but I say no, okay? The economic situation of Japan is like exactly 20 years ahead of Korea. Whatever Japan experiences these days, We will experience it later on, 20 years down the road. So what is Japan doing over there? Why do they have low credit rating? Again, the debt burden relative to their GDP, right? Looking at their population structure, okay? They have so many old-aged people, so the pension burden is very, very big. Compared to that, their productive age population is very small, okay? Sounds similar? Yes, right? We're going to have that problem in 10 years down the road, by the way, okay? So that's why Japan's rating is single A only. Used to be almost triple A, right? Used to be triple A when I was a college kid. Let's see, America. Where are you? America. Yeah, where are you? Double A by Standard & Poor's Plus, right? Wow, that's very close to South Korea. UK, Great Britain. Oh, same as Korea. Yeah, welcome. Welcome to the underworld. All right. But in the United States, S&P is the only exception. The other rating agencies say US is triple A. Well, Uncle Sam, right? Greenback, the dollar, right? All the currencies in, major transactions in FX market. 80% of the FX transactions is done in, US dollars. And oil, right? Those things are traded in US dollars, right? So what can you say? AAA is AAA, right? Not recent, 10 years ago when there was a financial crisis, it was downgraded a little bit like this in S&P because of the debt burden, right? Now we are going to experience another one because, as I said just before, the Steve Mnuchin, or what is Mnuchin, right? The U.S. government also announced that there will be fiscal stimulus, right? It's no time to care about this credit rating for their government right now. They have to stimulate the economy. We all have to stimulate the economy. So in Korea as well, if there should be any downgrading in credit rating for any countries in the future, near future, no surprise, quite expected, okay? That burden will be there, okay? But life is more important. Health is more important. So let's go through. That's going to happen in the future. Now, how about China? Where are you? Ni hao. Where you are. Okay, single A, right, all the way. And then other countries you can look for your own country. AAA, Canada, AAA, good. And Australia, where are you? Australia, AAA. And then Singapore, let me go to the country that I used to live before. Singapore, Singapura, and then this one, AAA, yes. So their government budget situation is a lot better. Okay, they can afford more fiscal stimulus, I guess. So that's that. Now, so sovereign bond rating, okay, is available for there. And then what do you do with this rating? Let's say Korea, okay, AA. Then you have to figure out what's the default spread that corresponds to AA rating, okay? Local currency government bond rate, okay? And then their bond rating is for this one is for number 1 over here, number 1. Yeah. Number 1, right? Local government, emerging government bond rating. In case your country like Korea has US dollar terms denominated bond traded in the market, then you look at this table, and then where is South Korea? Yeah, Korean won, right? Bond rating is 1.63 percentage point, right? Then what should be the default spread? Well, 1.63 minus US Treasury rate, whose maturity corresponds to this bond over here. I guess this is 10-year government bond rate or something. So 10-year Treasury rate, you subtract it. For example, if US Treasury rate is 1.5 percentage point, then 1.63 percentage minus 1.5 percentage of US Treasury bond, for example, which means 0.13 percentage will be Korea's default spread, if this is the case, right? Some advertisement pop-up is just bothering me, but let's bear with me. Anyway, so that's how we do it with number 1 approach. Number 2, credit default swap. Yes, we did it. CDS spread for each different countries in January time was like this. Let's see South Korea. Where are you? Where are you? Yes. US, what's that? At the end of last year, it was 48 basis points. Okay, 48 basis points. Just use it. This is just good enough. Okay. Some of the stringent people may want to subtract US's credit spread somehow. For example, US credit spread is not default risk-free, 18 basis points. So let's subtract 18 basis points from 48 basis points. That's 30 basis points over here. Okay, the idea is US is not risk-free in some sense, but in corporate finance purpose, just live in a simple world. Okay, 48 basis points, that's just good enough. Okay, and then this one I said to you that it changes over time very much drastically, right? Reflecting the real-time information in the market. So we just saw today's credit spread, default spread for Korean market. But let me find out what. Yeah. So let's see how the historical CDS spread has been doing, okay, for Korean government bond, right? By the way, CDS spread, right? Usually we base our comparison with a 5-year Treasury bond, right? It has to be standardized to be able to compare, right? So the market has set up that 5-year government bonds are traded very well, so that their CDS spread is widely quoted all across different countries, right? Korean government CDS spread right now, what was that? 51.987 basis points, as you see in this graph, right? And then it has been going up recently. Used to be 23 basis points as of February 17th, but it's been going up. There was a blip before January 27th, a little bit going up. Why was that the case? Well, coronavirus and Wuhan shutdown, right? And then there was some concern. Is it something going on? But then its initial stage, Korean government, and then these policymakers and the medical situation seem to be going okay, right? So they got overconfident a bit, and then it was reflected somehow, I guess. The situation seemed to be better than expected, so the CDS spread was going down a little bit, right? Ignorable degree, but what did we have? Shincheonji outbreak, and then now people realize that this is non-trivial situation, and then the fiscal stimulus has to be there. The default spread goes up, okay, like this, right? So that's what we can trace and infer from this graph right now. A lot more government burden, a burden on the government budget. So that's why we experience this. So that graph is 1-year chart. How about all-time chart? Okay, all-time chart or longer horizon. Well, the default spread has been like 40%, 40 basis points or something like that. So it's no surprise, right? Not much of a surprise. But the important thing is the steep rise, okay, of this CDS spread is not a good news. But let's see. How about Korea, not just Korea, but 5-year CDS spread. Can we look at US CDS spread, or spread of what? USA. Okay. Sovereign CDS. Okay, let's see. Yeah. We assume US to be AAA country, so no worries, but just for fun, okay? Is the CDS spread any changing for United States of America? Let's see, where are you? USA, where are you? It's not here. Yeah, 21.3 basis points right now. Right, and then you see over here in the historical CDS spread graph that this one is also increasing. Okay, so this is the impact of coronavirus, right? The CDS spread used to be very low, 15 basis points or something, but now 21 basis points, skyrocketing in this picture. But the magnitude itself compared to Korea is, not that much. How about our good old friend Japan? Where are you? We miss you. Japan. Yes. Konnichiwa. Right? Their CDS spread. Okay. Goes on. Theirs is also skyrocketing, right? Just like Korea. 41 basis points or something like that. Okay. That's interesting. Okay. Now, if we move down here, okay. What is the risk-free rate if you are valuing in Korean won? Okay. Let's say 10-year investment horizon that you got, and then 10-year Korean Treasury rate, it turns out to be 2.61 percentage point. Now, even if you're valuing in Korean won, right? This is not a true risk-free rate. Okay? It's just a usual risk-free rate people say in Korean denomination, but you want to be stringent over here to get to the estimate of true risk-free rate. What do? Subtract the default spread of Korea. Okay. So what do? Well, default spread of Korea, which is 0.41 percentage point in this question. So subtract this thing out. Okay, I referred this one from the the country's default spread in the ratings chart in the next page. Country's default spread, which is different from the CDS that I mentioned before. The CDS is about the credit default swap, whereas country default spread is based on the bond rating. Okay, bond rating by rating agency. So the risk-free rate, true risk-free rate of South Korea, well, 2.2 percentage point in this case, right? Because 2.2%, because this guy minus that guy, right? So that's why. So that's what's going on. Why is the default spread of Korea different? CDS-based default spread versus bond ratings chart-based default spread. They are destined to be different, by the way. CDS is a day-to-day, more frequently observed value in the market in real time, whereas bond rating is estimated every quarter or something, or slower. So this one is a bit slower compared to this one. So that's the advantage of using CDS spread. But at the same time, that's not all good story there. The negative side of CDS spread is that it contains a lot of random noises. So bond rating is more, stable, and then can be a little bit more reliable, less noisy, let's say, less noisy. That's the contrast between these two. Now, we move down, right? Typical default spread as of January 2020 is shown over here. AAA all the way down to single C, all different countries' ratings by Moody's is shown over there, and the default spread associated with it is shown over here, right? So that's, as long as you have your Korea's bond rating, okay, in like this in US dollar terms, then go for that rating. Oh, Korea AA over here, 41 basis points, right? That's what we do, okay, over here. Oh, Korea AA, 41 basis points, okay? That's it. Now, where is that? Yeah. How do I? Wait a minute. Now, risk-free rate when valuing in real currency, right? Real currency, 실질 달러 kind of things. Risk-free rate in US tips rate for all currency will be okay. This is Treasury inflation protected securities. It's a real dollar term, real risk-free rate, right? We are assuming frictionless global capital market. So assuming there is no transaction cost as you move your money from one country to the another country and the next country. No transaction cost or tax issues, no difference, right? Very ideal, very hypothetical world, right? Then your real risk-free rate in US dollars will be ubiquitously used for other countries' real risk-free rate as well. If not, real risk-free rate should equal long-term real GDP growth rate in that country. The government can promise to pay interest as much as the long-term GDP growth rate, right? Now, risk-free rate in local terms when no risk-free entity is there. The next approach is using interest rate parity relation. How do you do that? Well, for that part, you need to use the information coming from spot exchange rate, spot exchange market, and forward exchange market. Spot exchange market is like current right now. How much you say? Oh, what's that? The FX rate that you have to use, right, to convert your currency right now. Forward is about the future contract, right? It is slightly different from futures, but forward is 선도거래 in Korean terminology, and then you're promising with the counterparty that in the future time, let's say 1 year down the road or 10 years down the road, right? You promise each other that you will convert your currency with that reference currency at the currently promised exchange rate. Okay, the currently promised exchange rate should be different from your spot exchange rate. We call it forward exchange rate. Okay, so in picture diagram it looks like this. So here is your FC foreign currency yourself, right? Your country, and then here's another timeline that is EU, your reference AAA currency. Okay, not visible over here. I will throw it a little lower. EU. Okay, and you're standing over here, time point 0. Hello, right? And your counterparty is standing over there. Okay, hello. Okay, you promise each other, okay, that in 1 year later you will convert your currency into euro or vice versa at forward rate, the promised rate. Okay, forward rate. Okay, for a certain dollar, a certain euro, how much of a foreign currency you will do it. Okay? So forward rate like this. And the spot exchange rate is also there, spot market, FX market, right? Can you see it? Spot FX market. Yes. Now, what's the idea? You got the money over here, okay? FC, right? Foreign currency that you have it, okay? You have two choice, okay? And it should yield the same amount of euro value in the future. We're going to go over there, okay? The idea is whether you go this direction or that direction, you should end up with the same amount of euro money later on. If the capital market in the world is perfect, frictionless, okay? What's the idea? First of all, you can convert it, if you convert FC, okay, divided by your spot exchange rate, because you have to convert it into euro, okay, divide it into spot exchange rate, FX rate, and then you get euro, right? And then with this euro money, you invest in risk-free in euro currency. And then you will end up with certain amount of money with this return, okay? That's one way, convert into euro and then keep it at the euro risk-free rate. The other way is this. The other way is to put your money in your risk-free entity if there should be any. If there should be any. So 1 plus RFFC, okay? And 1 year later, you will get some money, right, as some return, and then convert it into euro at the promised rate, forward rate. So I would say 1 plus RFFC divided by forward exchange rate, FX rate, right? Then you'll be able to see how many, you will be able to have some euro-based money over there, okay? Whether you go this way or that way, you should end up with the same number. Make sense? So set up the math, right? FC, right? Your only amount, amount, okay? Divided by spot. What am I doing here? Some certain amount that you just don't know, okay? X amount divided into spot FX rate, and then 1 plus RFEU, right? That's this guy, the first way. Should be equal to the same amount that you don't know how much it is, right? Let's say this is X dollar, okay? We're going to cancel X, but don't worry about this X, right? X amount of dollar, right? And then invest it in your currency's risk-free rate, and then convert it into forward rate later. Notice this is division. Sorry. Right. Okay? So, what do we see? You start with a certain amount of dollar, or not a certain amount of FC currency right now, and then invest it in your country's risk-free security, if there should be any, and then later on converted into euro, right, at forward exchange rate, okay, should be equal to your original amount of money converted at spot foreign exchange rate into euro and invested in risk-free euro security. Can you see it? Right, like this. Okay, right. Yeah, this would be more visible to you. Okay, so that's the idea. You set up the math, and here, what you don't know, okay, what you don't know right now is this guy. This is the unknown. How about x? I told you, right hand side, left hand side, right hand side. We have it, so cancel each other out. And this is the only unknown. Forward rate, we have the promise, right, in the forward market. And then spot exchange rate, you have it in the market. And then risk-free rate in euro, you have it in the market. Okay? The only unknown is this guy. So let's solve for this one. That's what you see on your slide. So send this guy to the other side of the equation, forward rate over there. So what you're going to get is, can you see it over here? Right. My head is a problem. Okay. So I got a big head, so that's why you can't see me. See that? All right. So what you are going to have is 1 plus R F F C equals, right? 1 plus R F EU on spot rate times forward rate. Okay? That's what's happening in your formula. Okay? And then what is your true risk-free rate? If there should be any, well, just don't forget to subtract 1 later on. Right? Yeah, so that's the idea. And notice that this is because we are representing your FX relation in this manner, right? In this manner. For a unit of euro dollars, the euro unit, how many your currency unit should be spent, exchange in this format, right? So that's one thing to notice. Anyway, returning to our slide over here, example, right, is thrown out. The current spot rate is 38.1 Thai baht. Oh, by the way, you may wonder what that superscript over here is about, the T superscript and T superscript. Don't worry, okay? This guy is nothing but this one. We assumed it to be 1 year, but it could be any T years, right? What happens? Well, over 2 years or 3 years, 10 years. Let's assume compounded interest going on. Okay, compounded interest, which means interest bears its own interest in the future. So instead of having just one-time multiplication over here, we're going to have T times and T times multiplication, right? So how does that affect our equation over here? Well, it will be, I should state it this way. I should, 1 plus, can you see it? Yeah, right. R, F, F, T, F, C, T to the power of T, right? Should be 1 plus R, F, EU to the power of the same small t, of course, and forward rate divided by spot rate. That forward rate of t years later, okay, t years, right? It was just 1 year, but 2 years later. Solve for this guy. Solve for this guy. How do you do that? Well, what do you do? What do you do? Take the 1 over t's square root of this one. So that this guy will be the same, but what is that? Over here, right? This guy, square rooting each other will cancel each other out, but this one will be a problem. So 1 plus RF FC will be 1 plus RF EQ times the T square root of forward rate over 2 years, right? Spot rate. That would be it. Okay? Can't you see it? All right, there. Right? Don't forget to subtract 1 later on. Yeah, that's it. So basically, that's what's going on in the formula. All right. Example is shown. Let's see. The current spot rate is 38.1 Thai baht per Sing dollar, and 10-year forward rate is 61.36 baht per Sing dollar, and the current 10-year Sing Treasury bond rate is 5%. Then the 10-year Thai risk-free rate in nominal baht can be estimated as follows, right? Thai baht, right? So this T turns out to be 10, okay, 10. And then instead of euro, we're going to have SGD, and then this has to be Thai baht, right? Thai baht, and then 61.36, and then 61.36, and then 38.10, right? Should be there. And then Sing dollar risk-free rate is what? Bond rate 5% per annum, right? So that's what's going on. If you solve for this, and they do it this way, then you're going to find out that Thai baht is 10.12%. Okay? Right. So that's how we use interest rate parity relations. Now, next question. Wait. Similar one. Wait. Next one is about the Fisher equation, right? And then real interest rate versus inflation rate. Relation is shown over here. And then inflation rate, right? It should be expected inflation. And then what else do we have? Let's put some numbers here. Real interest rate is 0.53%, and then inflation rate is 2%. Then you can figure out the nominal interest rate of the United States, which is 2.54%. But inflation rate times real interest rate is very small, so treat it like 0, and then you will end up with 2.53%, which is not much different from 2.54% in the first place. So that's Fisher equation. The next is about what is that? Real risk-free rate all around the world, assuming frictionless capital market where money can move freely from one country to another, from US to Vietnam. Want to know the nominal risk-free rate of Vietnam based on nominal risk-free rate of the US and Vietnam, and on the expected inflation rate of US and Vietnam. So flip the Fisher equation. Can you do that? Yes. So assuming frictionless capital market, right? Now nominal risk-free rate of the US is nothing but the Fisher equation, real interest rate plus 1 times inflation rate plus 1. Okay. Now real interest rate of the US, 1 plus this guy, should be nothing but the ratio. Okay, the 1 plus nominal interest rate divided by 1 plus inflation rate. And then the idea becomes, then in a perfect capital market, the real and then the capital movement is free, and then real growth rate is the same all across different countries. Then we can assume that the real risk-free rate of Vietnam should be the same as real risk-free rate of the United States, and hence notice that real risk-free rate of Vietnam is equal to 1 plus this guy. It should be 1 plus real risk-free rate of the US. I'm sorry for that typo. One of them has to be over here. US, I should say. US risk-free rate over here. Okay, US. And the other one is Vietnam. Leave it there, assuming frictionless capital market. Now, right. So what do we use based on this relation? Well, each side of the equation, right? We can introduce our nominal risk-free rate of both countries and the inflation rate of both countries using this relation over here. Okay, equate these two, okay, and then you will get to this point, right? Then what does it tell me? Well, your nominal risk-free rate of Vietnam is nothing but this guy over here. The ratio between US nominal, your 1 plus US nominal risk-free rate times the ratio between the Vietnam and US inflation rate. Okay? Right. So, if you do the arithmetic, you will end up with this one, right? So, nominal rate of risk-free rate Vietnam should be this guy minus 1, right? The second term is differential inflation between the US and Vietnam. So the Vietnam's inflation rate divided by 1 plus US inflation rate. Okay. So so this is one way of getting to nominal risk-free rate when you don't have the information. Okay. One of the intuition that you can get is that the difference between the risk-free rate of two different countries, largely it is explained by the different inflation rate of the countries involved, right? Difference in risk-free rate pretty much explained by those inflation rate coming in, okay? Of course, some countries have high inflation, some countries have low inflation, primarily because they're economic expansion or contraction mode, right? High growth versus low growth, or even deflation. Okay. Now, next, yes, risk-free rate don't have or trust the government bond rate, and build-up approach is there for you. Okay. Right. Build-up approach, the risk-free rate in any currency can be written as a sum of the two variables, which is expected inflation rate and expected real interest rate. Okay, the expected real interest rate can be computed in one of the two ways: from the US TIPS rate or set equal to real growth in the economy. Thus, if the expected inflation rate in a country is expected to be 15% and the TIPS rate is 1%, the risk-free rate of your currency would be 16%, the summation of the two. Number 2, US dollar rate and differential inflation. Alternatively, you can scale up the US risk-free rate by the differential inflation between the US dollar and the currency in question. Okay, that's the one that I explained just one slide before. Thus, the US dollar risk-free rate is 2%. The inflation rate in the foreign currency is 15%, and the inflation rate in United States is 1.5%. The foreign currency risk-free rate is as follows: 1.02 times the ratio of that country's 1 plus inflation rate divided by, or the ratio of this guy, and 1 plus the inflation rate of US currency. Okay, minus 1, which is 15.57%. Okay. Now, okay, question here. You are doing business in Myanmar, and you need to estimate the value of a company of Swetong Group, one of the largest conglomerates of Myanmar, and Myanmar's true risk-free rate is not available. Okay. Seriously, a lot of Korean businessmen are doing working over there, right? In Myanmar, Cambodia, and this is non-trivial question. Okay. Some of you guys may be in the future, hopefully, maybe working in some unexplored countries, maybe North Korea. Oh my God. No risk-free rate available. Okay. What could be a good benchmark of it? Estimated, okay, with the following information. US dollar risk-free rate is 2.5%, the inflation rate in Myanmar is 6%, and inflation rate in US is 1.5%. Well, inflation, what do you have, right? The differential inflation, okay? Can you try to solve it somehow? Go ahead and do it. I give you 5 seconds, or you can pause it and then try it. And then the answer is like this, right? 1 plus US risk-free rate times the ratio of Myanmar's inflation plus 1 and 1 plus US inflation. So the idea is if Myanmar's inflation is higher than US inflation, then their risk-free rate will be higher than the US risk-free rate. And at the final stage, don't forget to subtract 1 over here. So many students, I tell you right now, okay, so many students forget to subtract 1 in the midterm exam and final exam and get some points off. There are infinitely many ways of screwing up yourself, and infinitely many ways of differentiating yourself, right, in positive way or negative way. Forgetting this is one of negative way of differentiating yourself. So don't forget, okay? Result, 7.0443 percentage point, okay? Right? Now, why do risk-free rates vary across currencies as of January 2020, okay? Not 2019. Here is a chart that shows the risk-free rate of all many different governments, treasuries. Vietnam, you see it, and Croatia, you see it. Japanese yen, euro, a very low regime over here. Very safe countries, I guess, or slow-growing countries. And if you see on the right-hand side, you see other extreme. Okay, Mexican peso, and then Nigerian, and then Nigerian naira, and then South African rand is also there, and then Zambian kwacha, right? The risk-free rate is really about 3 percentage point per year, right? Why do we see such a variation? Largely, yeah, now you have it, inflation, right? Different countries have different inflation depending on the economic stage they have, or the expansion or contraction of their business. Boom, bust cycle, all these kind of things matter. So that's pretty much it for today's lecture. Okay, this week's lecture. We came a long way. Okay, we compared to previous year, right? This year we are. I touched upon the central bank issue much more. Why is that the case? Because it is hard issue these days, right? With the coronavirus. Monetary policy versus fiscal policy. And which one can be more effective, right? Which one is the one that finance guys typically pay more attention to? They're different, right? And central bank, their role is critically important for valuation purpose, okay? Risk-free rate, right? How do we obtain those things? Treasury rate is important, right? Treasury rate. Now, Treasury rate, we learned that it is different from Fed funds rate, and that is still different from discount rate in the discount window in central bank. How this was established, and why does the central bank have to be independent from the influence of central government or the administration? Very important. I'm going to ask you in the final exam, right? Also, what else did we learn? Risk-free rate when the country is AAA, right? Versus non-AAA. Heaven versus hell. Should we say it? No. So non-AAA countries, we have all different kinds of estimating the true risk-free rate. In the industry, when you go there, right, they will say, well, forget about it. The risk-free rate of Korea, that's like, what is that? CD rate or something, right? Certificate of deposit, or the lowest possible rate of, 국고채 rate, like a treasury bond rate, that's it. But we want to be stringent about it, okay? Even if the treasury rate of Korea in Korean currency looks risk-free, but it's not really risk-free, because when it comes to real, when it comes to true power or capacity to repay the debt in whatever currency it may be, okay, US dollars or euros or whatever, they are not really risk-free. There's some default spread, and we learned about how to figure out those default spread. Once you figure out the default spread of Korea, subtract it from the Korean government's treasury rate. Subtract the default spread from 국고채 rate. Why? The industry guy will say crazy, but we want to be strict about the true risk-free concept over here, right? And then later on, we will worry about this, add back those default spread or something in the future in the name of more country-specific spread kind of things, okay? So that's one thing I wanted to tell you, right? And then the country spread is going to be easily that default spread. We are just identifying that default spread and then take it out to get the true risk-free rate. Later on, we are going to add it back in the name of country spread. And then we are going to add the risk premium later on to get to that full discount rate of your country, your company, okay? So that's it. Risk-free rate is done. Next week, we're going to talk about market risk premium and then move down to beta in the following week, okay? So I hope you enjoyed my lecture, and then see you next week. Bye-bye.